Welcome to Growth and Exit Strategies for Software and IT Companies, the flagship tech conference of the World Financial Symposiums. The GXS conference caters to tech founders and investors in tech M&A, covering topics like investments, growth strategies, buyouts, sales, divestitures, and mergers. Thank you for joining us. Let's begin.
Now let's move on to our investors panel, where we'll answer the question, will your strategy get funded? Moderating this panel is Kristin Fox, founder of FoxInspires. This is a great opportunity to listen to what investors are looking for. Kristin, the floor is yours.
Good morning, afternoon, evening, wherever you are in the world. First of all, I'd like to thank WFS for putting together a truly extraordinary panel of women investors. I think today is going to be extremely exciting. My name is Kristin Fox, and I will be your tour guide for the next hour. Let's get started. Rather than my reading bios, I'm going to ask each of these incredible women to introduce themselves and explain why they're here and what's important to them here. Ute, can we start with you, please?
Yes, hello, everybody. My name is Ute Mercker. I'm investment director at IBB Ventures, which is the venture fund of the state of Berlin. We are an early stage investor with a very broad scope of technology and impact investing, covering healthcare, which I'm responsible for, as well as technology, creative industry, industrial technology. We do early stage investments up to 5 million into a company over the lifetime of the investment circle, and have currently roughly 300 million under management and 90 portfolio companies, which every company is headquartered in Berlin.
Thank you. Diane?
Hi, I'm Diane Freeman, and it's great to be here. I'm in Portland, Oregon. I'm with Voyager Capital. We're an early stage B2B software investor in the Pacific Northwest, so Oregon, Washington, and Western Canada, so Vancouver over to Calgary. We do really cross-industry, although right now there are certain industries that are exciting me that we'll talk about. But we'll get in at that first institutional round. We take a board seat, we get in to stay in, and we are in Fund 6. So we are roughly a $100 million fund, roughly $600 million under management, and I look forward to talking about it some more.
Thank you. Anna.
Hi, I'm Anna, based in Stockholm, Sweden, and I work for Industrifonden. We're an evergreen fund based out of governmental money, and we've been in the market for 40 years. Our portfolio is 70 companies, and we have about $500 million US under assets. So our investment strategy is 3. We do life science, deep tech, and transformative tech, and I'll come back to those 3 areas later in the discussion. I'm also head of sustainable investments and form that framework for our portfolio companies. And all our companies are headquartered in Stockholm or in Sweden.
Thank you. Well, let's get right into it here. Let's talk about the fundamental characteristics of the companies, the sectors that are really intriguing you now, and why. Diane, can we start with you?
Yeah. So as I said early on, we do B2B investing and early stage software investing. And we're agnostic on industries, although we go where the money is. And so if you were to look at what was exciting me in the past few years, has been basically because of the changes in the workforce, et cetera. So things like workforce enablement, as an example, have been areas that we've looked at. But in addition to that, we also look at where markets and technology finally intersect. And for us, one of the most exciting areas has actually been in ag tech. We've looked at ag tech for many, many years, and the farmers weren't ready to buy the technology that was coming out. And that has changed. It's changed because of climate, labor, insecticides, or organics. And so there are markets like ag tech that we're leaning into because we believe that some of the new technology, whether it be Gen AI driven or whether it just be operational efficiencies that are gained, it's a market that we think that we're going to see quite a lot going forward as well. So that excites us too.
Wonderful. Thank you. Ute, what's going on in Berlin?
Oh, as you might know, a lot is going on in Berlin. We have a very vibrant ecosystem for startups. And Berlin is a center of healthcare. Since we started our fund, which was 1997, biotech investments, medtech investments in diagnostic companies were always on our radar and in our portfolio. But in the last 8 to 10 years, digital health has become more and more important because in Berlin you find the tech founders and the tech employees and graduates from the universities, as well as the environment with Charité, the biggest hospital in Europe, research institutions. So there is a melting pot of founders from both sides, which you need if you want to bring tech into the healthcare market. And so we are really have companies in our portfolio which have a clinically proven app to support patients with depression, which is reimbursed. We have companies which provide AI for pathology to support pharmaceutical companies in cancer research and clinical trials, as well as companies who provide chatbots for doctors in their private practice, which are taking on the phone calls and providing appointments. So it's a very broad scope. And we believe that we need to bring digital solutions into healthcare to make the overall healthcare system more efficient and bring the healthcare professionals back to what they are best trained for, providing medical solutions and support to their patients.
Thank you. Anna?
Yeah, now I'm trying to reflect. I spent 10 years within VC, and I think Stockholm and Sweden are well known for life science, really good examples of that coming out of these grounds, but that's more 20 years ago. I would say lately we've seen a lot of fintechs, companies like Klarna, example is a famous one. We also have Spotify, and we have some amazing tech unicorns. As for now, I think what's trending more is the impact in climate tech sector, because that's really where the money is, and we can see much higher valuation and a lot of startups coming in that direction from here. And in Industrifonden is perhaps we're an early stage investor and we can take technical risk, and some VCs cannot do that, but we can do early pre-seed research-based investments, which is phenomenal because you can get in early and we can really spot out the opportunities for these technologies and take them globally. We've done at that time when we did the investment, deep tech wasn't really invented as a word even, but we were famous for Oatly. It's an oat-based milk that is now spread around the world, and that was actually funded by Industrifonden back in the early days. So, but that's what we do. We don't really look for the real quick ventures, but we can stay in a technology and enable the commercialization. If it takes 10 or 15 years, that's fine. If the market needs this, that's when we see our believing, and that's where our investment thesis will go.
Hey, Anna, I'm curious how much money you put into those pre-seed deals.
So basically our spread is, thanks for asking, our first ticket size is typically $2 million. And then over the lifespan of the exposure, we can go up to $20 million. Typically it's between 2 and 10, I would say. So we do the pre-seed seed A rounds, and then we take our pro rata in the B rounds and perhaps in the C rounds. I think since we're not too driven by the exit, we just see as long as we have a good value creation by being still on the board most of the times, actually, even after the C rounds. And it makes us like a really appreciated institutional investor, I think.
Yeah.
I can imagine that. That's very exciting.
Yeah. But all of us seems to have the same kind of, well, you're a little more into health tech, and I'm perhaps a little more biased towards the tech sector. But I mean, this is really a global industry, venture capital, and specifically the early stage ones.
Very much so.
Yeah, I agree. And I think tech was the origin of venture capital, to provide capital to very innovative technicians and researchers who wanted to bring their invention or product into the market. And the swing back to deep tech, I think it's a very important one, because it takes maybe longer and it's sometimes more difficult, especially in healthcare with all the regulation about market entry. But it's worth it because the impact can be substantial.
Drilling down a little bit deeper here. As investors, you have a lot of best friends in terms of companies that would like you to fund them. But what are the fundamental characteristics of the companies that you invest in? What do you need to see to have a second conversation?
Well, I'll start on that one. I mean, it's funny. We get asked this question a lot, and it's such a simple answer. Very disruptive technologies in really large markets that have great teams. Yay. There you go.
Ain't going that.
Right, exactly. I mean, it's really a simple answer, and then you realize just how hard that really, really is. And the hardest part, actually, I think, is the people part, especially when you talk about early stage, because it's very easy to do diligence on disruptive technologies. I mean, it either is or it isn't, or you think it is or it isn't. And it's easy to do due diligence on a large market. You can decide that something's ready for disruption. You can decide that it's overly complicated by the market map. You can decide that you like it or don't like it. The magic in, I think, what we all do, and this is where the years of experience begin to really play into it, is finding those early stage teams that can, in essence, execute on a great opportunity. As we all know, the best products don't always win in the market. And in fact, quite often, it's not the best, most innovative product that wins. And it largely is based on that execution, whether it's the infamous product market fit or the go-to-market strategies, or just watching the market and listening to the customers. So simple answer, really hard to actually make work in all the sectors that you're looking at.
Is there anything that you've seen as you've looked at companies and talked to people, and we all know that in those early stages, it's the people you're investing in. Is there something that has consistently stood out to you with the groups that you've written checks to? I know that's a horrible question.
Well, for me,
I can answer because I want to echo exactly what you said, Diane. I can't frame it any other way, but the ones that stood out was perhaps the ones that over the years of the development of the technology or the commercialization had the ability to adhere to the market changing or to the team's need for something new. So the adherence and the humbleness towards their own skills and how you have to adjust that in your growth path. That's, for me, what's sticking out between the winning teams and the ones that get into a more arrogant phase when they're not succeeding as planned. So I think
that's really insightful.
I think so.
I agree, Anna. And I think what we try to do is in this phase of due diligence and talking about terms, we try to find out if we are able to find compromise with the founders. Founders are very important for us. We have learned that if it is easygoing, which is basically never is, but if you founders have to evolve, and they are the ones who make a company successful. So the founder teams are very important to us, and we try to understand, are we able to find a compromise? And negotiating the contracts is a very good way to find, to probe that, so to say, because that's what we again and again have to do. Sit together as shareholders and have a discussion about what might be the best next move, what people we might need in the company or on C-level, and if you can find an understanding and commitment to the company and to, in tech, it's sometimes commitment to the technology too. It's very important because you're going on a roller coaster, so to say. Even if the company is growing from the start heavily, this is a different kind of roller coaster, but a big challenge for the management team as well. So for us, we are really very founder driven, and we want to see that we can work together with them because we have more than 25 years experience in venture investing in our team. I myself here with more than 25 years. And we think we need to be able to give advice, not to be know-it-all, but at the right point of time, give the right advice, which might change the direction or not, but might have an impact for the overall success.
Yeah, and maybe we should add for the audience that at least when we do our investments, we are always on the board of our companies, which makes us really an active owner, an active investor. So so what you're just saying is we will be sitting in the same boat, so we will have to talk to each other about ways forward. And there are other investors, passive investors, that might just pitch in some money and see what happens. But we're really, when we invest, we are really committed to succeed. We want to work hard and for a long time with these companies and the founders. And so we need to talk, we need to go through highs and lows. And because that's what this is about.
Yeah, we're the same. We always take a board seat, and it's a dating game. You date and you get married. And and if you didn't like them during the dating, you sure as hell are not going to like them during the marriage. Yep. So the conversation of the upfront, the negotiation, you see a lot, I always like to say, if in that first meeting you sit there and the founder is going, I, me, I can solve this, I can do that. It's like the biggest red flag on the face of the earth, because it is all about the team. It's about the founders being able to build a team, about them being able to listen. And we've been saying back and forth. And again, it is a dating game. You're going to date them for a while, then you're going to get married, and then the conversations really start. And as there's got to be trust, and it's a long relationship. So it's one that to do it well, you need to take time, and it's got to go both ways. And they've got to do it the same way. If they don't like you, it's not going to work either.
No,
right?
Exactly. And that's what brings this industry pretty individual, because when you meet with investors and you meet with entrepreneurs, they meet Anna or they meet my other colleague. Her name is also Anna, but she has a complete different profile. So it's I think it's important to state that it is. We usually say it takes 3 months from a first meeting until we can close a deal, and that's a pretty fast path in our world. And then they say, why does it take so long? And the answer is, well, it doesn't take that long. But we want to date you for that long at least, because there's a lot of things. And that's what you said, Jutta. You go through the negotiation path and the due diligence path. So it makes sense. You have to get to know each other.
And if I might add, we have to agree to the way forward. If they propose whatever strategy they have, we don't believe in, then we would not, even if we like the product or technology, we would circle this opinion we have or the findings from the due diligence back, and we would say then we will stay away, or we will move away, because we say I cannot follow a proposed path of business which I do not trust into. I mean, we all have, I think, have seen companies pivoting and changing because of market or technology changes. That's normal. But if the first proposed business plan we do not believe in, then we would not invest, even if the team is great.
Yeah.
Thank you. This is really extraordinary. Let's move on a little bit more to the companies that you've invested in or the specific technologies. Anna shared a story earlier about oat milk and the extraordinary success of that. Thank you for that, making that investment, by the way. We talk a little bit more about things that you've each invested in and the process you went through.
I'm happy to start. I think the company I'd like to mention, which I adore, is called Syndio, Syndio. They're up in Seattle, Washington. It's a phenomenal woman CEO. She's not the founder. She was what I'd call a hired gun CEO. She came in after the founders when the angel investors recognized they needed to make a change with the founders. And they originally brought her in, Maria Colacorio, as the CMO, and within about a week recognized she actually was the CEO. And the Syndio story, when we invested with Emerson Collective, which is Lorene Powell Jobs' investment arm, was pay equity. But pay equity was all part of sort of a wedge strategy into workforce equity. And when we invested in it, Maria had been on board for about a year. She had seen the platform have great potential steered in a different direction. She repackaged, repriced the pay equity solution and started to basically go after mid-market companies. And when we looked at it, we said, you're looking at the wrong market target. The market target should be public companies, Fortune 500, because the last thing they want is the New York Times headline that there is your served group of employees that are suing, which is going on a great deal, both here and actually in Europe. And so we did the original funding for that right before the lockdown in 2020. They were about $2 million exit ARR. Jump forward 3 years later, they are about $35 million exit ARR, and they've gone from pay equity to opportunity equity. So how many Black women engineers in New York City are getting promoted at the same level that they are for the team in Berlin, as an example. Beyond that, now what folks like Walmart, Microsoft, American Airlines, Aon, Siemens are all looking at is overall compensation management, business alignment to business strategy and overall compensation. They are by far the strongest and biggest player in this market right now. They take the data from Workday, SAP, ADP, et cetera, and that data goes into what is a very smart, yes, AI-driven backbone to their analytics that in essence allow you to dial and have transparency in any area. And what I love about this company, not only is that the market opportunity and the growth, but Maria, as a CEO, is remarkable. And where she gets as a first-time CEO, she was a co-founder of another company in Seattle called Smartsheet, which went public, but she wasn't the CEO. Where she gets her knowledge is just this innate ability. She is the chief paranoid, which I love. There's always a backup strategy. And she is the experimenter. She sits there and she knows when to lean in, when to stop, when to basically make a change, because early stage is all about experimentation, I think. And when you find something that works, you put the pedal to the metal, as we say, and you lean in. And so it's been a joy. The board, the other unique thing, which I'm sure my colleagues will appreciate, this is a board with one exception of all women on the board. It is the only board that I'm on that's, in fact, it's the only board where I'm not the only woman on the board. And this is all women and a guy. And boy, is that a lot of fun and is that different. So I get up every day very very happy to have them as part of my portfolio.
Bravo to them and to you.
Yeah, great company.
Ute.
Yeah, I in my introduction, I think I mentioned one company which I would like to talk about a bit. The name is Selfie. Was founded 2016 by two psychologists and one woman with an MBA, with the goal to support patients who suffer from depression. Because what they noticed was you wait in Germany, and I think the same in Europe, everywhere, maybe 4 to 6 months until you get an appointment with a psychologist to support you. And depression is a disease where you can get into a kind of downward spiral, where people even don't get up anymore in the morning because they feel so bad about their overall situation. And they made the decision, I'm going to change that. But the CEO, Nora Blum, she said, yeah, I have no idea how to set up a startup and how to run it. So she decided to join Rocket Internet. I don't know, Anna, maybe you've heard about it here in Berlin. This was a startup factory where you just went into like a school to learn what a startup all about, how to go into the market, what KPI you need, so on. So she did it for 18 months, and then she said, oh, now I'm ready. And they started this company, and we invested 1 year after launch. In the beginning, it was just self-payment, something in the browser, and a weekly phone call. But for somebody who was only lying on the couch, even the phone, they can still use their handy and make a phone call. And they saw that these things improved the life of people which had no access to support anywhere. Over the time, the company changed their business model from marketing budget from health insurances to contracts with some health insurances, so they would cover these for the patients, until Germany set up a new law that there is a clear path into reimbursements for apps who support patients. We call it DIGA. And they have now 5 DIGAs. This started right in the pandemic, 2020, when this law came into motion and the company started to get registered or certified for this being a reimbursed app. And the company now has 5 DIGAs. 4 of them already have a clear, proven clinical medical benefit in a controlled trial in depression, over 400 patients, and more than 30% improvement against the control group, which is comparable to a drug, what we know about, because especially psychiatric diseases are hard to treat with drugs. You might know that because it's not too easy to enter the brain, because there's a blood-brain barrier. So this is really remarkable. And every doctor in Germany can prescribe these apps to a patient, and they can use it for 3 months and then another 3 months, sometimes just as a tool, as long as they are on the waiting list to get a personal treatment with a healthcare professional. And it's founded by 3 women, so to say. And like Diane mentioned, the board, I was not always the only woman there, like what we know in our industry. Usually it's maybe 2. And it was a very exciting path to be on board of this company, especially now with the pandemic. Depression, panic, anxiety is, at least in Germany, very normal to talk about, that people suffer from that. It's out of the taboo. But at this time when we invested, it was not like that, and there was not much support provided to these patients. So I was really happy to join as investor the board and to invest into this company, because we see the impact this company and their solutions have for the patients. And it was just said in the news a couple of days that every year 18 million people only in Germany suffer from some kind of depression, panic, anxiety disorder. So this is a huge problem, and the pandemic has increased it everywhere. So I'm really happy that this company is there and has a solution, and this solution is reimbursed. So there is a clear access, low hurdle solution for people who need support until they find a healthcare professional.
Is it also for young people, or is it mostly for adults?
It is unfortunately certified mostly for adults, so from 18 years on. But I just learned last week that there is a solution which is now reimbursed too for teens, so to say.
Yeah.
I know what you're talking about, especially in the pandemic. There was a huge need for these people between maybe 14 to 18. There is no other company.
Yeah. No, but based on the future, I think we will see in the lights of social media a lot of mental health issues for our young and even children. It's going to be very important to cover and support the younger generations going forward.
I agree.
Interesting investment. Well, I'm going to brag about 3 companies, but actually just talk about one. But first, I want to say I have done an investment in a female-founded company. It's a payment fintech company, payment infrastructure for B2B, and our vertical is ERP players, to give them and their customers payment opportunities, not only for payments between accounts, but also for FX solutions. But it's a female founder, and it's an all-female board, which is, well, it was for 3 years. And then we actually decided it was too stereotyped.
You need the guy, there's no question.
But it's an early stage company, and the second one is a deep tech investment that I've done, and it came out from research from University of Gothenburg, and it's an amazing technology for the semiconductor industry, where they actually comprise data in a super efficient way, so that you can install this, and all the data centers can actually lower their energy usage by 50%. So data centers will have benefits from this, and also the device players who can integrate this technology and have a better user experience. So those 2 on the side. But the one I really want to talk about is TrustRace. And TrustRace has, over the last 2 years, it was founded by 5 Indian guys, and they were from Honeywell, ABB, Microsoft, and they saw the amazing need for the traceability of suppliers. So in all industrial verticals, we know that there's going to be a real game on how can you prove where the things come from and what they've been through. And they have developed a program for this, and have chosen fashion and shoe as their first vertical. And I'm really proud to say that these guys have all the significant qualifications needed for being a great team, but I also deliver on spot what they say that they should, including listing the 200 top global brands. And they're just basically checking off that list on a monthly basis. So we have full coverage from Nike, Adidas, Asics, New Balance, and all the other bigger shoe brands. And now going to Moncler, Boss, Hugo Boss, Prada, Inditex. And they just raised their B round as planned 2 years after our A round. And we had a little venture debt in between to bridge that. So they got $25 million signed a month ago. And the development team is in India, and the headquarters is in Stockholm, and their biggest market is in the US. And so I'm not sure how they might pivot in a year or so, but right now they're exactly on track. And we have such tailwind when it comes to the regulatory frameworks and the big brand and logos willingness to read. There's like a pull from the market to get this. So I'm very excited. And I just spent a few days in an all-staff meeting that was arranged in India. And I saw this excitement in this team, 110 people, and they are just doubling up the coming 12 months. So that's hopefully a unicorn.
That's always fun.
So much fun.
Yeah, it makes up for the ones that aren't doing so well, and we definitely have those as well.
And we all know it goes like 5 on the 1.
Exactly.
But you need that to for your own mood. Yeah.
Yes.
It's hard work sometimes if company are not on track and you try to find out how to help and to have a discussion. So you need and we all are willing to roll up our sleeves and support, but you need these companies which are thriving, and we all know there might be problems around the corner as well, but you need that
Exactly.
for your own work spirit, right?
No, I think as an investor, I hope you agree with me. But the adjustment that we've been forced to do in terms of lower valuation in all SaaS companies, etc., it has been the task for the investor to really educate the founders in this. So I felt that I've been missed bad news in all board meetings and everywhere, because I'm like, had to really talk through what the market says, not what I say, but this is the reality now compared to just 12 months ago when we had the double multiples, for example. But now it's bouncing back again, actually. Now there's like a lot more energy and a lot more willingness from investor side. But it's
the reset's been positive actually for us. I think because we sit as a neighbor to Silicon Valley, and we basically all share deal flow and investment opportunities. Although we moved out of California because it's just ridiculous in terms of how the math works. The reset's been positive, but to Anna's point, it has taken conversations, especially with first-time CEOs. First-time founders, for them to just understand the reality, not only reset, which, what they need to understand is that the past few years were the anomaly. The reset's back to more
normal. Yeah.
reality. Exactly. So that's the first thing, and the second thing is, there's a real education to some of these early stage founders that it's not good for them to actually try and go for these paper valuations early on. It actually puts them into a situation where if they do everything right, but still miss the milestones in those first 18 to 24 months, which, by the way, they will, because unless my two colleagues here are more super women than, stuff happens, right? You do everything right and stuff happens. And so, explaining to them that the valuations will catch up downstream if they start to execute, they'll have negotiating leverage in those follow-on rounds, that it doesn't make sense for them to fight over some of these valuations for this first round, is eye-opening to see who gets it and who doesn't. And I think it goes to a little bit of what Ute was saying as far as the negotiation early on, that you see, do they listen? Do they understand? Are you going to be fighting with them about this? Because that's the last thing we want. So the education right now is a lot of the conversations going on for me as well.
I agree. And I my experience in last year was every month valuation were going down a little more. And I had a company out in fundraising. It was an uphill battle, and we had a first closing now in January, but it was there were some days where it was on the thin line, and I think it's really important to tell somebody that it is even a high valuation in whatever round in a bubble market, so to say, is a pyrrhus victory, like we say, because if the markets are going down, And even if you hit your target, you will be in a price range, in a valuation range, which is not fitting to the market anymore.
Exactly.
So I always say you can price out yourself out of the market, even if everything goes well. And then you are sitting on a company where you have last investors in at the too high price. They won't like a down round, and you are in the middle of the situation. So it's better.
That is artificial. I mean, there is
exactly.
real about that number, right? There is nothing real other than what some determination is against the marketplace. And the marketplace is completely not real as it relates to real early stage investing, because you can see how fast it can reset.
Yeah, exactly. And then you are in between a rock and a hard place to find a solution for the next round. So better maybe a smaller check at a decent valuation and try to hit target and then see where we are within 2 years.
Yeah,
That is
I guess
what I'm trying to argue.
The question is, at what point do you just, as the investor, and I'm going through this right now with one of my deals, do you basically just say, you know what, we're going to walk? Like, you like the deal, you put down the term sheet on the deal, or at least you're close to doing that, and you're finding that you are really in this back and forth with a founder or an entrepreneur that's just not getting it from my perspective. Their perspective, maybe I'm not getting it. And at what point do you say, you know what, the math just doesn't work? Like the deal, would do the deal, but we're out of sync in terms of where we think the valuation is. It's a hard call, right? Especially on the ones that you've spent time on.
Yeah.
But at some point, there needs to be the decision as to, I'm out because the numbers aren't going to work for you or I. And it's all about the money, unfortunately. I mean, we want you to build a great company. We love your technology. You can solve world hunger. But really, it's all about the money.
Yeah. And I think what perhaps we could be better at also from our side as investors is to really spend more time about convincing them that we will be a longer term investor. Because so in that said, if you're marrying someone, you will go through the high and lows, and you will have to take a retake once and then. And I think sometimes we end up spending too much time about, asking the company to come to us and convince us, but we don't spend enough time from our side with our team. We're typically a team of 3 where we do a transaction. It's like we should go out and dine. We should have them talk, and not only talk, and we always give them the opportunity to call our portfolio companies for reference. But we should actually put them together, and so that they get a deeper understanding of the value of us as investors, not only the valuation of their company.
Absolutely.
You're right. But you want to add, Anna?
No, but I think it's getting better now. And Diane, I walked away from a deal in January because they didn't meet their goals, their annual targets for 2023, and our evaluation was set on that. And I just felt like there wasn't a co-understanding of that we would do the hard work the coming 5 years. So we have to have a decent standpoint when we start, and it's a really tough decision.
It's a really tough decision, and it's a hard one to deliver. And yet, again, it's all about the math. We can sit here and be compassionate, and we can sit here and be excited, but at the end of the day, the job we're in is to make money. Yeah. And, at some point, that's what this comes down to. And as you've all said, and we're the same way, we work our tails off once we get in. We get onto that board, we get involved, we work hard, and, and do it with passion and do it with conviction, So, everyone's got to be sitting on the same side of the table going into this, because it only gets harder.
Yeah. Yeah. And you wake and you sleep, go to bed with your portfolio companies, and I totally acknowledge the feeling that you said about the company being out fundraising and finally getting their first close. I mean, our companies, when they're out, of course, we usually say that, well, we're backing you with our pro rata to have the good storyline or even more. But at the end, they have to raise their funding by themselves. We can only support as good as we can from the side and open doors. And it's so nerve-wracking and sometimes painful to just see that little company being out there. And then finally...
And we try to support them. I mean, we pick up the phone and call investors we know.
Oh, yes.
And make an intro and everything. But if the market's going down, you have a term sheet on the table which is not going to be signed. And this can hit a company which has been trusting into the situation very hard. Yeah. And I had to walk last year in November as well, because we were just discussing that the valuation is that the targets were not met, like you said, Anna, and the valuation was not justified anymore. And we knew the next round is within 18 months. Mm-hmm. And with this proposed, they were never going to raise this at this post. So I had this, we said we have discussed it, and we said it's not going to work for us at this valuation, because we know the next round you're not going to close this with this post money. I'm sorry. The market has developed. I was talking to them more than 6 months, and I have to deliver that. And we have learned the hard way. It's better to be upfront, as long as you are not invested in, open and honest with your opinion and your judgment. And it is the question how to deliver it. But the message is the professional one. And they had other investors. So, yeah, we are still talking. Maybe it's going to work. They took the message in. But if I really love the technology and the product, but is this gut feeling, like you said, it has to work as an investment in the end, Diane. Absolutely. So I see it as my professional duty, with the experience we have, to give them an opinion which is solid. We can argue it, yeah, and then they can take it and do whatever they want. We would just tell them, look, this way we can follow you, this way we cannot follow you. It's not like we know everything, but that's our judgment, and we have to deliver it to you. And I put in a lot of time. We would like to be on board, but it has to work. Mm-hmm. And it's really sometimes hard, because my background is an MBA, so I cannot fall in love with technology, but still I can fall in love with good companies and good management. Absolutely. But I'm still an investor, and I try never to forget that.
Each of you takes a board seat in the companies that you're involved in, and at your early stage. So this is long-term bears. This could be 10 to 20 years. Never know.
Well, the 10, the 20.
You can also divorce.
So at some point, some of these companies are going to go for a second round, or they're going to look at other things. What's the advice that you would give them before they move forward?
On another round, or on what?
Or on finding another financial partner? Should they go for an acquisition? What's the next step in their growth?
Oh, well, basically, can I take that?
Yeah.
Basically, what we talked about, all three of us, is you align an owner's agenda, really. And that covers it depends, but it could be from 1 to 3 years. And it includes the basically some milestones, an aspiration of getting a market position somewhere in the market, or opening up new markets, or if there's a technology, tech company, it's tech deliveries. But an owner's agenda is always there, and it's being revised as often as needed. And sometimes you forget that, but I think it's a good written document that's actually a statement that goes into the board to execute on. And so it's a common view on like, okay, this is the funding we have now. It should reach typically 18 months, sometimes a little more, but that's the normal, 18 to 24 months. And that's how long it should take them to reach a certain company value. And that's when you plan for the second round. And that's the whole game. So, and that's when we invested in a company knows that, okay, if this is going to be successful, we can see already now that it's a universe of investors looking to these targets. They want to invest in the B round or in the C round. So that's the value chain of venture capital, basically. But then there's also an exit agenda at one day. And that's typically what we also talk about with the founders in the beginning of the process. So when entering into company, we agree upon that this is one day going to be exit, because otherwise we're not interested. And so that's also important to state. And usually if you go into an exit process, you align that up to 20 months in advance to kind of dress that out and plan it out. If there's an IPO, if there's a tech trade state industrial, or if there's a private equity player coming in, acquiring the assets. That's how we do it. And then we help them to introduce them to our advisors that we've had before, that we trust. If we see that the taker of this company is in the US market, then we typically take a US advisor. We perhaps know that the US companies would like us to show footprint in the US market, even though they would acquire this based on the European footprint. So there's a lot of really fun discussions and strategies before you're exiting, I would say.
Thank you. We've got a couple minutes left. And I think there's the big question in the room. The headline question is AI. And what are your opinions on it? And has it changed your investment thesis? If so, why?
Well, I do realize that AI is not new. So let's just start there. AI is not new. We've been investing, I'm sure all of us, in AI, ML, machine learning, initially a decade ago as a set of tools, and now as just foundational technology that are really, I'm sure, behind almost every one of the investments we make. The Gen AI hype, which isn't hype, it is technology to the next level of the AI roadmap, is very exciting to us. We do, I'm sure, all laugh that every deck we now see has a .ai after it. So everything's now .ai. But the reality is, I believe that it's still going to take a little bit of time before what I call the AI sparkle dust. So the AI sparkle dust is the open AI, the open API that you can use right now inside of any of our portfolio companies to add real value and operational efficiency, especially in content generation, et cetera. The AI sparkle dust in almost every one of our portfolio companies was integrated into the roadmaps in 2 to 4 weeks of availability. It's simple, it's easy, it is not a moat, it does not provide a lot of differentiation, it may provide some operational efficiencies, and it may be some cool feature functionality. But the really cool stuff, which is going to be built from the ground up, I believe, we're just starting to see, and I think, really is going to be what's exciting over the next 18 to 24 months in all markets, especially you folks looking at healthcare. I think we're going to see some amazing things come in through there. I think supply chain, we're going to see some amazing things. And I think inside of core technology, we will. But, what we're finding is there aren't a lot of developers still out there. I mean, the guys that were doing sort of core AI are now learning how to do the Gen AI, the tools. Again, it's like back to the future. We're seeing new tools come in. We see them all the time, especially in our market, since we're sort of at the epicenter of the cloud infrastructure world. But so it's exciting. It's early. There's some very quick wins. But I think that we're still probably a good year before we start seeing really stuff that truly, I think, moves markets.
I agree.
Yeah. And I would say in healthcare, we have AI investments since 3 or 5 years in our portfolio, something like digital twins or like I think I mentioned before, I have a company, a spin-off from Charité, which have AI solutions for pathology. And now they have published that they have a basic foundation model for pathology, which is then a huge step. And they are planning to invest into that as well. So I think we are at the beginning here. And in healthcare, it's a lot about regulation. And there is one regulation discussed in Europe, so in the EU, another one in Germany, because everything is about access to data in healthcare, how big the data set is, and the quality of the data. We know that in radiology, AI can make a real difference, supporting the doctor to be much better in reading maybe breast cancer screens. There is already publications out there where you can see this. So this is more a question of regulatory approval and reimbursement for that. That's the hurdle there. The technology is there. It's proven. It's access to market and how you can make money out of that. That's the question there. And this can be a huge game changer for emerging countries as well, to have access to this kind of technology, because there you don't have so many healthcare professionals. So an AI-supported solution can be a big game changer in healthcare. But what we first ask is, how big is the data that you have access to? What kind of data is it? Have you annotated data, or are they clinical proven records which you can use to train your AI? Because that's what it's all about. But I'm pretty excited because I see, when I started to introduce myself, I said it's a lot about efficacy in healthcare, especially in North America and Europe, because the boomers are getting older. So we are running into a shortage of healthcare professionals. And technology, digitalization, and AI can help us to solve that problem. And that makes me excited, because I want to be part of that solution with the investments I made.
Thank you. Anna?
No, I agree. And I'm really excited about the opportunities that there is within the healthcare sector when it comes to AI. Our deal flow right now is AI, but it's so low AI, so it's ridiculous. So there's like this buzzword going on. So there's not just like shuffling through, but there's some really cool stuff out there as well. But I would say as a board member, AI is on the agenda on every board, just as Diane said, because it's needed to be implemented in all companies as quick, and it's pretty easy, as you said too.
Super easy.
It's like low-hanging fruits.
Yeah.
Thank you, ladies. I think we are out of time. You've given us some extraordinary information and wisdom and plenty to think about. And thank you so much for truly being part of the solution.
To our audience, we appreciate your participation today. Visit WFS.com for more information on events coming up. If you'd like to get in touch with the WFS team, speakers, or the Quorum Group, email us at info@wfs.com.
World Financial Symposiums, the education centre for tech leaders.